All right, all right, all right. I am ready to rock and roll. And we've got a good show today. We are going to have a lot of fun because we're going to combine two classes. We've been working down at the university on options trading. And of course, last week we talked about day trading. So this week, options trading. And tonight we have our final class of the semester, believe it or not. And then we go into the holidays and celebrate Christmas without any pressure of school. Doesn't mean you students can't keep studying. You have to study all during the whole holidays. All right, we're going to keep trading. We're going to keep playing. We're going to keep having labs. Even though class is not in session, we're going to keep coming here and having labs. I do have some stuff I have to do next week. So I'm not exactly sure how my schedule is going to go for the labs next week. So just make sure you subscribe and ring the little bell, click the little bell until you want to be notified so that when I do go live, then you'll be notified so you can come and join us, because I don't know what my schedule is going to be. We'll try and make a schedule up once I find out how things turn out next week, but next week's going to be kind of a funny schedule. All right. So we're going to go through and we're going to combine the two classes. We're going to combine the options trading class with the day trading class. So today we're going to day trade with options. How's that sound? That sounds fun, doesn't it? We only have 1 hour left till the market closes. So yeah, we're going to have to kind of just play with it a little bit and see what happens. And I want to do a lot of testing. All right, I want to do some testing. We're going to put a bunch of different options on. We're just going to watch them and see what the differences are and see how they react to the market. And that's mostly what I want to kind of do today. And I want you to kind of do this with me. If you have track and trade, if you don't have track and trade, you can go get it. Don't go get it right now because you'll miss the class by the time you get it all installed and everything. But go get the software. Here's where you get it.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so go get track and trade, and then we're going to be using the futures version today because when we day trade, we like to day trade in futures because we don't have all those pattern day trading rules to deal with, and we have the leverage, and we can do a lot of stuff. Not that you can't do options day trading. You can on the stock market. But we're going to have leverage on top of leverage. So we have a lot of leverage over here in the futures market when we do the options. So we're going to have a lot of fun with that. Let's just go in. And what I want to do is I just kind of want to put some different types of options on so we can watch them and see what the advantages and disadvantages are of each. We got to get them going. So because we can't sit here and dilly-dally around. So let me show you just real quick what I've got for you. This is how markets can go up, down, and sideways. All right. How to directional trade each move of the market rule of 33, 33, 33. So you have a 33% chance of being right anytime you pick a direction because the market can do three different things. The market can go up, can go down, it can go sideways. So if the market can go up, there's 4 ways you can make money. You can buy a contract in the futures market. You buy a contract, right? Buy, go long. You can buy shares in the stock market or either market. You can buy a call option or you can sell a put option. Now we're going to do options today. I don't think we'll do any contracts. We might do a contract just as a comparison, but we're going to primarily focus on our options. We're going to buy a call option if we think the market's going to go up, or we could sell a put option if we think the market's going to go up. All right. So we're going to come in here. If the market goes sideways, the only way to make money in a sideways market is to sell a call option or to sell a put option. All right. You have to sell and collect premium in sideways markets. If the market's going to go down, the way you make money is you short the market. So you sell a contract, you sell it first, buy it back low later, and then you sell or short the shares in the stock market. And then you can buy a put option, right? Anytime we think the market's going to fall, we want to make money off of a falling market, we can buy a put option, or we can sell a call option. All right, we can sell a call option. And that's how we can make money on the market going down. So let's take those rules and go over to the stock market and let's put some of these on. Since we're going to do options, we could do a contract too, just for fun to see what it does. Let's just go put some of these on and let's see what the market does. And the market's kind of dead. I don't know why the market's always dead when I'm trying to teach these classes. Sometimes we get really good rolling markets and they just make all kinds of money, but sometimes the market's dead. Remember, I mentioned to you in class when we first started that 80% of the time our time is spent trying to figure out when to trade. 20% of our time is figured out how to trade. How to trade is easy. It's just learning the tools in the software, right? Learning the rules of the market. When to trade is the hard part. So hard to know when you want to put those orders on and what types of orders and how you're going to sit on the top of those orders and wait for them to perform for you. That's the hard part of trading, learning when to trade. All right. Now, indicators, we got mathematical models, we got recurring price patterns, we got Fibonacci ratios, we've got delta Kona probability, things, all kinds of things that can help us to try and determine when to trade. And that's the hard part of trading, learning when to trade. The easy part is, you're going to use an option. I think the market's going to go up. I'll use a call, or I'll just buy a contract, or, market's going to go down. I'll buy a put, or I'll use a contract. That's the easy part. The hard part is, when are you going to put that order on? So right now we're going to come through, and because we've got 1 hour and I just want to example a bunch of stuff, we're going to come in here and we're going to go and look at this. We've got 0 days, we got 3 days, we got 4 days, we got 5 days. We're going to do a 0 days till expiration, which means it's going to expire at the end of the market hour, which, I mean, we got 1 hour on the stock market, but then we have the after hours. So in the futures market, it really doesn't expire until 3 o'clock. So we're going to come in here and we can buy a call if we think the market's going to go up. We can sell a call. So we're going to come in and we're going to, these are puts. Let's come over to the calls. And we're going to just buy a call right at the money. So let's say we think the market's going to go up, you buy a call. Now, another way you can make money is you can sell a call, right? But that's only if the market goes down. So let's come up here and let's sell a call up here. Actually, I want to do these on different tickets. So I'm going to clear this one. So let's go ahead and just buy our call first. So we're going to come in here and we're going to actually let's do a put too at the same time. We'll put these both on the same ticket. So we'll go to traditional. Let's go to traditional, and we'll do one of each. We'll do a buy and a call. We're going to buy a call and buy a put. We're going to put them right on top of each other. This is called a straddle. All right. So we're going to come in here, just mark it in. Let's get these on there. So we're going to get those on there. It's not going to let me mark it into them. You rotten dog. Edit. Let's go in here. Come on, delete. Let's delete this one too. Let's try again. We're going to buy this one, and we're going to buy this one. Okay, so we're going to buy a call, and we're going to buy a put. And we're going to come in here, and we're going to go up to $8. I wish it would just let me do it. Come on. Put them on there. Come on. How can I example if you guys won't fill my order for me? Come on. Edit multi-leg. It might not let us do it with the zeros with 1 hour to go. Come on. You should let us do this. Let's try again. All right, now the market's moving against us. So we're gonna buy a call. Where's the best we can do? Let's go out. Let's go. Maybe it doesn't like the 0 days. Let's try 3 days out. That's the best it's gonna. Let's see if it'll let us do 3 days out. Okay, so we're gonna come in here. We're gonna buy, and we're gonna buy. So we're gonna buy one of each, and we're gonna buy them right on top of each other. Market's almost where we're at. So we're come in here, and since we're gonna buy and buy, we got a 33.25. 33.25. Let's go ahead and place that order. Come on, let me have them. Oh, come on. Don't tell me you're not going to let me have any options orders today. You're kidding me. Well, it's not going to let me edit them either. Delete multi-leg. Come on. Let's try again. Okay, we're going to buy, and we're going to buy. Come on. Fill them. Why are they not filling our orders? It's not letting it order or not letting us do anything with them. Let's try selling some. Okay, let's try selling some. We're going to come in here. Let's try. We'll sell this one and we'll sell this one. Let's just try to market order in. Come on, sell them. I don't know what's wrong. We may have to go and just trade trade contracts instead of options. Trade ears not letting us do anything with the options today. Well, that's disappointing. How are we supposed to learn if they won't let us fill our orders? Come on. Are you guys having problems too? Are you guys that are following along having problems getting your orders filled? This should not give us any problems. Let's come down here and do a 3-day again. Let's just buy a call. We'll drop it in here. Trading. We'll just do limit order. And since we're buying 1625, place an order. There, it filled that one. Anyway, it's only going to let us fill one at a time. All right, we bought a call and we'll buy a put. We'll do it now, see if it'll let us buy a put now. So we're going to go up to 1675. It's not letting us do 2 at a time. I don't know why. Because of the spread, maybe. I don't know. Anyway, we're in. Okay. We got our 2 orders. We got our 2 positions, all right, in this chart. So we got 1 call and 1 put. Now we're going to sell a call and a put. So let's come up here. It's not going to let us again. I wish it would let us do the 0 days. We're going to sell a call up here. That's $37. And we're going to, it's not, we'll probably get chewed up in, okay. And let us sell that call. Now we're going to sell a put down here. Now, come on. Let me add it. Let me add it. Sell a put. Is that a put? Sell a put. Yeah. So now we're going to sell a put. Okay. We got all our orders on now. All right. So now what we want to do is we just want to watch them. They weren't letting me put them on all on the same ticket for some reason. I don't know why. Probably because the spread was too wide and I was not offering enough money. But I was trying to do a market order, wasn't I? So, all right. So now what we've got. Well, let's see what's happening here. Now, we've got 0 days to expiration on that. On this one, we got 3 days till expiration. So we bought a put with 3 days till expiration. We bought a call. So our ones at the money right here are and look, we had to pay. We lost $62 on the spread on that. On the put that we bought. That's ugly. So you can see how much money we're making and losing. We're not making anything on the call. We're losing 75 on the put. So we're just day trading these things. Let's just watch them and see what they do. All right, it's going to take some time. So now you have to just kind of wait and see what happens. But I wanted to do one of each just so you could watch all 3 of them. Now this is what I want you guys to do. Now when we go in and when we go into the futures market and we want to trade options. Now there's lots of things you can trade options on, but my favorite things to trade options on to trade in the futures market are the indexes, the NASDAQ, the Russell, the Dow, and the S&P 500. Out of those 4, the only ones that have options that are viable are the S&P 500. So that's why we're trading the S&P 500 because that's where all the options are. All right. So when you trade in the S&P in the futures market, this is where the options are. So that's 0 days till expiration are the ones out here. So we just sold premium out here. We're just waiting for the market to just die and go sideways. Because remember, when you sell an option above the market, all it has to do is stay below. It has to hit the purple line, which is the close of the market right here, underneath the red line. And you get to keep your $37.50. Now we had to pay $7.50 just to get in. Oh no, wait, that's not our premium. Let's come back down to our positions. How much do we have to pay for that? That call is 0 days till expiration. The call that we sold a call, and we had to pay $37.50. No, that's not current value. 47 delta settlement. Where's our cost? I think we had to like a $10. So it was like a $10 fee to get in or something. Can't remember what the spread was. All right, but the market's going against us, right? So we sold our call up here. We're down $15, but that's only if we get out, right? If we bail out of our agreement. Now, our agreement was that we're going to hang on to this until it hit the yellow dot line here. But if we start to get scared that it's going to go hit the yellow line above the red line, then we get out early. Well, we're going to take that. That's the loss we'll take because we're not going to stick to our agreement. Okay. Our agreement was to hang on to this thing until that point right there, which at what point we would take delivery of a short position of the S&P 500 from whatever level that is. So we're going to receive 37.50 as long as the market stays underneath that red line. Now, on the other side, we sold a put down here, and we received 42.50. So we've already received that. We get that money, but remember, we also owe that money. So it's the little T square. So we have we received 42.50. We received 37.50 here. We got that money, but now we have to give it back if the market goes, by the time it hits that purple line, if it goes underneath that red line. So that's for the put option. So since we got one of each, we would just want the market to go sideways. We don't want it to go up or down. But we've also got these in here that only make money if the market goes up or down. So we're watching 4 different markets at the same time. And so this is actually called a butterfly pattern, an iron butterfly, the way we've got this put on here. But what we're really doing is we're looking at the calls and the puts. We want to see what happens to them. Now, this is the sell a put. So the put down here, this is the one that's up $10 now. All right. The buy a put, okay, we bought a put right here, and the market's going in the opposite direction. Remember, you make money when the market goes, when you buy a put, you make money when the market goes down, but the market's going up. So we bought a put, and so we're losing $100 right now because the market's going up. But look at our call. You make money when the market goes up, right? But we bought a call, 3-day call, and look, it's still not moved. We're not making any money. We've lost 100 on the put, but we've made nothing on the call. Well, that sucks. That call's not moving. It's not making any money. Now, it also doesn't look like it's playing. It looks like it's not getting any data. It should be moving. I can't believe it's still sitting at 0. Why is it still sitting at 0? It's like it's not getting any data feed. Because it should be making money. It should be making about $100 right now, and it's not making anything. How come it's not making anything? We don't have it's not dead. No, it's open. How come that option's not making anything? That's not right. Something's wrong there. It should be making about $100 right now. We did buy a call. Yeah, it says we bought a call with 3 days till expiration. This one we bought a put, and it's down $100. This one should be up $100. Well, I don't know why. All I can say is it's just not working. For some reason, they're not feeding us any data on that call. But we know it's going to be just about a little bit different, just the opposite of the put. So where the put is losing 112, the call should be making about 112. And it's not going to be exact. The call's not going to make as much as the put's losing. So, but it'll offset it pretty much. See how this one's offsetting. So you get your sell put and your sell call. We're up $12.50 on this one, but we're down $10 on this one. So that's a wash because we did one on each side. But all this one has to do, remember the puts, all they have to do to get your money, we got the 37.50 on this one, and we got the 42.50 on this one. All we have to do is wait for the market to just hit this line out here underneath this red line, and we get to keep our 37.50 and our 42.50. Just stay inside that little triangle we've drawn in there. In fact, I'll draw it as a triangle. Like we'll do this for the inside for these out here. Actually, yeah, all it has to do. Well, it's like this. All it has to do is stay inside of that triangle. Wow, that triangles are funny how they draw them. Okay, let's try it again, just for fun. We'll do it like this. Like this. Oh, that's not working. That's close enough. Okay, so as long as it stays inside that little green triangle. Hold on, I'm going to sneeze. As long as it stays inside that little triangle, the puts will make money. The puts will pay off, all right? They can't go outside of the red lines. But the calls, the call option, you want it to go as high as you can. The put option, you want it to go as low as you can to make money. So now remember, the whole idea of doing both of them at the same time, not very wise at this point in time. But the idea is that you have the maximum amount of now these have, we could only get the 3 days to clear. We couldn't get the 0 days on here. So these are going to be 3 days. So they're not going to expire until Monday evening, Monday market close. Okay, look at our put option and our call options that we sold. So we sold them. We got $250 or $2.50, $7.50 here. We're down $37.50 now on our put. We were down $100. That's because the market's coming back in our favor. So what should be happening now is this one. Now the call option, which was up $100, technically speaking, is now down back to losing all of its money. So it's back to zero again. This has now lost $50. And it was down $100. So if the market would turn and fall, the call option would make more money. Len, why didn't you take it when it was up? Well, because it's not working. I don't know why it's not working. And look, we're right at the back at the exact zone. Let's kill this one. Liquidate this option because it's not working anyway. Let's just get rid of it, see if it'll let us kill it. Okay, it let us take it off. So let's buy our call again because it's going to buy it right at the money. Okay, call one, open, 0 days till expiration, 345. Okay, let's buy that. Come on, buy it. Now it wants 360. Okay, it gave it to us. We finally got that in there. Now let's see if it's going to, see if the dumb thing's going to, okay, it's working for us now. Okay, so our call option that we just bought, buy a call, that's up here. Okay, we're down $5. So it's working now. So we got that one to start working. All right, so now we got everything going. They're just not together. We got our buy call up on top. We got our sell put, and we got our sell call, and we got our buy put. So we got a buy call up here. It's losing $12.50. Our buy put is losing 50, but our sells are up $2.50 and $7.50. All right. And we're trading on the mini, not the micro. So you can see that when we trade the options, it's not nearly as scary as trading a contract, because a contract makes and breaks a lot more money. Let's put one on. Okay, let's put a contract on. Which direction? Let's just pick a direction. It's going down. We'll pick. Let's just buy one so we can see how much we're going to lose or make on a contract. We just put one on right here. We just put a buy on it. Okay. All right. So now we can compare all of them together. So you can see the option versus the long position. Okay, so we got one long position. It's at 14 days till expiration. That's because this particular market expires in 14 days. So it's down $25. So the market's falling. So if the market's falling, the put option the buy put should be making money, right? The buy put, where is it? Buy put right there. Well, it's not making money yet. It's losing $12. What's making money? Our sell call. Oh, this little call up here, see? Made $15. Now, that's only if you bail out. You can bail out right now and take your $15. But if you don't bail out and the market hits remember, if it hits that little purple line out there, which is actually yellow in this market because the expiration and they're both there at the same time, you get to keep $37. So right now you sold this call. Now the problem with that call is you got a big you've got a big cost basis on it. See, this days till expiration on this one is our buy. Oh, that's the market cost basis, $30,000. That's the cost basis on putting our one position on. But our margin on it says it's $7,000. Our margin on it's only $1,400. I don't know why it says it's $7,000 right here. That's not right. Yeah, that's not right. I don't know why it's saying it's a 7,000. That's our contract, isn't it? Yeah. It's not an option. Or is that no, that's the one we bought. And then we got a buy call. Our buy call is down 37 because the market's going down. Our sell put, okay, we sold a put. That's this one. Our sell put, well, you can see it right here. It's down $5. It's easier to just watch it on the screen because now you can see which one is associated where. So this one is actually not losing anything. It's not making anything. It's just sitting at 0. But don't worry about that because that only doesn't really pertain to you. It only pertains to you if you get out early before it hits this number here. So when this market gets way over here next to this yellow line, this should be right close to $42. And this one will be right close to $37. As long as it's below the red line here and above the red line there. You just get to keep your money. Okay, you get $37.50. But if you bail out early, you can get $10 on this one because it's currently at $10, and you'd get $5 on this one. Because remember, time decay is what's making us money here. We just have to wait for time to go by. The market doesn't have to move; it just can't go up or down. If it goes up wildly, well, it'll look like it's losing money, but that's only if you bail out. So they try to scare you out of there. Okay, so we got liquidate value would be 30. You paid 37, or you received 37, so you'd have to give 30 back, which means you could keep 750. Does that make sense? All right, let's move me out of the way here. I'm going to go up to this level here so you can see these numbers. All right, so we're just going to kind of sit in here and watch them and see what they do. Everything's working, so we're in good shape now. We got everything working the way I wanted to. All right, so the market is going. So we bought the market here, and it's going up. So you can see we're up $100 on just the long position. We're up $100. But our buy call, our long call, the call, which is right here, market has to go up to make money on that one. Buy the call, that's coming back down. Those two top ones, market has to go up. Sell a put. Okay, that's this one down here. Sell a call. Now it's this one up here. And then buy a put. That's this one right here. Okay, so you can see that the buy a put, losing 37. The buy a call is losing 40, losing 37. The market's not going anywhere. That's good for our options that we sold. Now, we didn't sell them right at the money. We sold them out way a little way, so we have a little buffer in there. Now, you can sell them right at the money if you want to. We could go do that, but I can't. I don't have another market that I can do it on. Maybe we could go do it on crude oil. Crude oil's open right now. We could sell them right at the money, and we could see what they look like. Does anybody have any questions while we sit and watch the market move? When you trade options, there's not really a whole lot to do. You just kind of wait, right? Wait for the market to move. And hopefully you pick the right direction. Hopefully you pick the right direction. Man, what if I'm not good at picking direction? Well, go further out. You don't make as much money, but you have a higher probability of making money. Okay, so now the market's going down. Our long position, right? We got in long right here, so it's losing money. It's losing $50. Our call that we got in, which of course, when you buy a call, that means you're going to lose money. If the market goes down, make money if the market goes up. So that's why we're down $60. These two top ones, the market has to go up to make money. Now this is sell a put. So we sold a put. That's this one down here. Market's coming against us, so it's going to show a drawdown, right? Well, it's showing a $12.50 drawdown. But that's only if we bail out right now. We don't have any plans of bailing out right now. Why would we get out? We'd take a loss. But up here on the other side, if we bailed out, we'd get to keep our $50. We have to give 25. They've already given us $37.50. That's how it works. When you sell a put option, you immediately get the money. But you also have that little T-square that we talked about in class Wednesday night. So you get to keep $37.50, but you immediately have to put $37.50 in the debit column. So you have a debit and a credit. So the credit comes in at $37.50, but you immediately have to put money into the debit, the same $37.50 into the debit column. So they wash each other out. So this is the credit column right here. This is the debit column right here. And then this is the difference between the two. Now, right now, $37.50 is in the credit column. If you bailed out right now, well, you'd have to give them back $25, which means you could keep $15. See how that works? It's right there, little T-square right there. Same thing down here. They gave you $42.50. The minute you sold that put option, they gave you $42.50. That's in the credit column. But immediately in the debit column, they put this number, which is now 45. So it means that you'd have to give them back $47.50 if you bailed out right now, which means you'd lose $5. But you don't have to bail out right now. You can just hang on to it. Hang on to it until it gets closer over here and the debit column goes lower. Failed trader. Oh, that's a sad name that you picked. Let's change your name. All right. If you're having problems, Paula, with the software after class is over or right now, you can call Gecko Software and have them tech support you. Their phone number is 435-512-07. No, that's not what it is. 435-752-8026. 435-752-8026. I'll say it one more time. Get your pencil out. 435-752-8026. Call them on the phone. Say, my software won't update. They'll probably do a little thing where they take control of your software, take control of your computer, and they'll go in and they'll fix it. All right? They'll help you. Call them on the phone, and if they don't answer, it's because they're busy. Leave a message. Somebody will call you back. Or you can reboot and try again. Sometimes that works. Turn your computer off, turn it back on, click the button. Usually it goes right through. All right, so this one's still at zero. Market's falling, so we're down $25 on our contract. We're down $30 on our long call. Oh, contract's back to $37.50. It's trying to go up again. This market's really dead, isn't it? Oof. Okay, so on a dead market, the best way to make money is with just selling calls and puts like this. You just collect premium, but you have to wait for it to go all the way to the end. So we're up $17.50. So there again, they gave us $37.50. If we bail out early, we have to give them $20 back, which means we get to keep $17.50. Down here, they gave us $42.50. If we bail out early, we have to give them back $42.50, which means we get to keep nothing. You are trading a sideways market now. Would you normally be doing this? I like to trade markets that trend, and we've not having a lot of trending markets lately. So the only way to make money in a non-trending market is to sell premium. So would I trade like this? I wouldn't trade with these call ones in the center, these ones that make money on a trending market, but this, yeah, absolutely. Selling premium that's the fun part. I mean, that's easy because you don't have to, all you have to do is just say, I don't think the market's going to fall below this red line. It's going to hit that yellow line before it hits. It's a carnival game. It's just a carnival game. This snaky thing here, this little red and green snake cannot go below the red line. It has to hit the yellow line before it hits the red line. If it does, if it hits that yellow line anywhere above that red line, I get to keep my 42.50. That's the carnival game we're playing. Now, we did the same thing on the upper side. So we said, okay, I'm going to say that this little green and red snaky thing is not going to hit the yellow line above the red line. If it hits the yellow line anywhere below the red line, I get to keep all my money, my 37.50. That's the carnival game you're playing on the upside. So the fact that we put both on, we put a call, we sold a call and we sold a put, that means we need the market to just stay inside of that box. We created a box, and the name of the carnival game at this point is the snaky thing, the little red and green snaky thing, has to hit the yellow line inside of that box, and we get max profit. We get to keep both the 37.50 on the upside and 42.50 on the downside. So 4, 5, 6, 7, roughly 80 bucks. 80 bucks in the last hour of the day. It's actually going to be 2 hours because the market has to go all the way till 3 o'clock. All right, we got 20 minutes until the market closes, 1 hour into the market, and then we're going to have another hour of the after hours trend. And usually the after hours goes, markets are dead, but we'll see because sometimes they take off. But it's dead right now. So that's the snaky game you play when you're playing with options. So you just say, as long as it stays inside that box and hits that yellow beauty, I made 80 bucks. And that's just one. We could do it twice, do two on each side. We make 160 bucks. How much you want to make? And then you're like, well, Lan, what if it goes outside that box? Well, then you don't get your money. And you lose money on the outside of the box. You have to, you still get your money. You still get your 37.50 no matter what. If it hits that, if it hits that yellow, when it hits that yellow line, if you don't liquidate them, you get your 80 bucks no matter what. The only difference is that you might get assigned to shares over here, but if you liquidate at the very end, you might end up, if it's outside the box, you have to give a lot more money back than what you made. You might have to give them, you might have to give them $50 back and you only made 42. So you'd lose $10. You could do that. Or you have to give them $100 back and you only made 42. So you lost 60 bucks. But that's the game you're playing. All right. That's the carnival game. So the selling the options is really cool and really fun if you think the market's just going to be dead until which seems to be pretty dead. I mean, it's Friday afternoon. Who's trading on Friday afternoon? Nobody. Okay, we'll sell some options. Just collect some premium. Market doesn't have to go anywhere. It just doesn't have to go anywhere. So the name of the game is, do you think the market's going to move or do you not think it's going to move? If you don't think it's going to move, sell some calls and puts. Now this is a cash secured call and a cash secured put, which the cost on that, the margin on that can be pretty heavy, and you have to have enough money to put on the contract size, which is just quantity one. So you have to have enough money to put on a contract because it's going to assign you a contract. So you might want to we can do a little bit of a different strategy. I'll teach that. Maybe we'll talk about that tonight in class. Then we can do it next week. Again, next week might be a little bit kind of a crazy week for me. I'm not sure when I'm going to be able to do it, but we'll go in and do some of these additional trading strategies. Right now, I just kind of want to example very simple, just the simplest form of it, so we can kind of get the idea under our belt. Then we can start buying insurance and protecting ourselves against a huge move in the market. Because if we decide we're going to put on this little snaky game right here, and we're going to say, okay, I want the market to just stay in the box, but yet it leaves the box and goes a long ways out of the box, well, that can be dangerous. Right. So what we do is we buy insurance to cover ourselves. And those are called credit spreads and debit spreads. So we're going to talk about credit spreads and debit spreads today in class, maybe tonight, but then in our lab next week. If we have, depending on, again, my schedule next week's kind of screwy. So it might be the week after. But and then we got Christmas coming up. So this month's just kind of messy. And then we got New Year's coming up. We got, and then we start in January, we start the university classes all over again. So it's just whenever I can get in here and set up some classes. Right now, again, I just go through this real quick. You can see they gave us $37.50 for this one. So we received $37.50, but we have the little T square. So that means we owe them $37.50. The minute they give us $37.50, we owe them $37.50. But the way we make money is to have time go by. Time just has to go by. We have time. Time is the extrinsic value we talked about in class last night. So extrinsic value is time going by. So as time goes by, that's how we make money, or the market moving in our favor. That'll make us money too. All right. So we owe them. They gave us $37.50. We owe them $37.50. But now, because the market's going in our favor right here, you can see that if we bail out early, we only have to give them $10 back. And that means we get to keep $27.50. But if we don't bail out early, we get to keep our full $37.50. As long as it stays inside the box, that's what we want, right? We get a little bit extra money and another $10. We come down here, it's the same thing. So we receive $42.50. We owe them $42.50, but the market's going against us. So if we bail out right now, we have to give them $52 back or $50 back, which means we'd lose $5. They gave us $42.50. We have to give them $45 back. Well, we're back to break even again. So $42.50 is what they gave us. We have to give them $42.50 back. We wouldn't make anything. But that's only if we bail out right now. We don't want to bail out right now. We got lots of buffer in here. Look at that. All that room in there for that market to go stay in. That's why I kind of like the little triangle, because that's kind of what we want to see. We want to see it stay inside that little triangle. That's all we have to do. When you sell options, that's all you have to do. You just have to sit around and wait for your money to come in. So remember, when we go to our options chain, we have a little column in here called come on, populate. Why am I not getting my options? Sometimes the internet, when I've got all of this streaming going on, I've got all of these markets coming in. Let's come and see if we can reduce some of our load. We're loading the Dow. Let's get rid of the Dow for now. Let's get rid of the NASDAQ. We got 2 NASDAQs we're streaming in. Try and reduce my load a little bit here. Russell. Daily. Let's get rid of all these things that are taking up extra data. See if that'll help. Positions, close, options chain. We've lost connection on the internet on that one. Are you guys still hearing me? That's a good question, Lauren. You are correct. When you put out your order, if there's not, and I'm not getting any options data in here. 2-minute S&P 500 December. This should be options data in here. Why are we not getting any options data? No options available. Yes, there are. We're trading them. S&P Mini, 2-minute. That's really weird. I'm going to save this. I'm going to close it. Open it back up. Not that one. Click the wrong button. I don't want stocks. There's our 15-minute bell. Yes, somebody has to buy the other side. And if there's nobody there to buy the other side, then you can't get your order filled. And sometimes the simulator simulates that. They're like, well, there's nobody there to buy your other side land. So in the simulator, they won't let me buy the other side. And sometimes I'm like, well, just let me buy it anyway. I mean, it's a simulator. Come on. Come on. I'm trying to teach a lesson here. Well, there's nobody there to buy the other side. The volume is too low. You wouldn't actually be able to do that. I'm like, well, who cares? It's a simulator. Let me teach my class. But that's how they do it. All right. Let's see if we can get our options chains. There we go. We lost a little connection on there. All right, so these little things here, that's what we're doing. All right, we're back to normal again. I had to just open and close the software and I lost my internet connection. So there's the data. There we go. So we're going to come in here. And what I wanted to do is I wanted to go just over to the call columns, just the calls. And in here, we have a column called calls premium per day. We're going to have to go to a 3-day. Okay, premium per day tells you how much money you're going to make or lose per day on that option as the time decays. So at the money, this 3-day call option would be $793. And so it would lose $264 a day just in premium. Okay, we're starting to, there, the market's starting to move for us. Now we can really go see what's happening to our options. Okay, so our contract, we went long our contract. So the market's going against us on our contract. So you can see we're down $250 on our contract. That's why you just want to get out when you're wrong with the contract. Okay. If you're not right, just get out because it makes and loses a lot of money. Now we got options down. This is the buy call. You can see it's losing $137. So $137 is what it's losing. So all these people are bailing out of the market on a Friday before the weekend. So that makes sense, right? So if there's nobody there to buy on the other side, then you have a hard time getting in. Now there's market makers, and they'll take your other side if you give them enough money. Okay. So there's market makers. There's guys sitting there, companies that do that for a living, just to take the other side of your trade to give liquidity to the market. But they won't take the other side of your trade unless you offer them a lot of money. You have to give them the full spread or else they won't take your other side. And then even sometimes they won't take your side on that other side. So sometimes it's hard to get into a market that's really thinly traded. But this market shouldn't be thinly traded. These options should, well, the 0 days till expiration are probably thinly traded right now because there's only 10 minutes till the market closes. So there's not going to be a lot of people buying and selling options right now. You might be able to get out, but you're going to have to pay the full spread. All right, see, this thing's coming down. It's getting ready to touch our red line. So you can see how now that's a good example. There we go. Okay, so we're going to lose $125 if we bail out right now. We're going to get $42.50. We have to give them back $42.50. But we now, because the market's moved this far against us, we have to give them back $150, which means if we bail out, well, we're going to lose $100. So we're down $387 on our contract, okay, because the market's going against us. And our buy call is down $147, which is half of the contract, which makes sense because the delta is about half. Okay, the delta was 0.50. So now, and we'll talk about delta tonight in class for those of you who don't know. And then that's the call. And then we sold a call. So the call that we sold, this is the put. So the sell that we put is down $120. So there it is. That's the one that's losing $120. But the option to sell the call that we sold is now up 86% or $32.50. Now remember, the max amount of money we can make is $37.50 because we sold it. So we sold it for $37.50. Our loss potential is unlimited. That's why you're down 110 here and you only receive 42. So you receive 42. If you bailed out right now, you'd have to give them 150 and you'd take a $107 loss. So it's 162 minus your 42.50, which you get to keep. You get your 42.50 no matter what, but you're down 170. So 42 plus negative 167 is a negative 125, right? So you're still losing money. That's how that works. But that's only if you bail out right now. If the market stays and turns and goes and hits that yellow line still inside that triangle right there, you're going to get to keep your 42.50 because this number here doesn't pertain to you unless you get out right now. It only pertains to you when you liquidate the market. And I'm not going to liquidate the market right now. We're going to wait for it to go to the end, right? We think it'll stay inside that box. Now, if it keeps coming down, you might want to liquidate, get out, just take your lumps, which is why we also do credit spreads. We can buy some insurance to protect us against that loss so it doesn't get too big. All right, so we can protect ourselves. That's called a credit spread. We'll do that tonight. This right now is just called I was going to say it's an iron butterfly, but it's not really. It's not really an iron butterfly because we're selling the wings. Usually we buy the wings on an iron butterfly. We sell inside and we buy outside. This is just the opposite. We bought inside and sold outside. All right, so there's the one we bought the put. Okay, there's the one that's making money for us. Look, we bought the put and it's up $212. So that put that we bought right there, right? When you make money, when you buy a put, the market goes down. So we're making money on the put, $212. And the call that we sold, because we make money when the market goes down. Remember, see, look at this. We're getting there. The way you make money when the market goes down is you sell a call, right? Sell a call or you buy a put. And we did both of those, and we bought a put. We bought a put and we sold a call. So we did both of those. So that's what's here. These are the two that are making us money. Now, the max amount of money we can make on the one that we sold is the $37.50. But the put option, when we bought it, that profit is unlimited, right? The maximum amount of money we can lose is the premium we paid for it. But the profit potential is unlimited. That's why we're up $300 on that put. That market starts to drop. So see, you can day trade with options, and it kind of makes it's not quite as scary as trading contracts. You can just kind of trade them. That's why if you're going to day trade, now remember, there's a difference between scalping and day trading. Day trading is saying, well, I'm going to believe that the trend overall for the day is going to be up. Well, instead of sitting there and worried about having a contract that can be a lot of money up and down, right? You could just buy a call option and say, well, I'm going to buy the call. The max amount of money I can lose is the premium I paid for it in the morning. But I think we're going to have a bullish day because we've had bullish days the last 3 days. I think it's going to have another bullish day. By the end of the day, you have whatever your call's worth. You can do that. It's a kind of a very simple way of trading, of day trading. So day trading with options is, in my opinion, a lot less scary than day trading with a contract. It doesn't make you as much money, because the delta is only half, so you're going to make or lose half as much money. Actually, you can lose the max amount of money you can lose is the premium you pay for it, but this is over 3 days. These options have 3 days, so it go all weekend long, and then we still have Monday to trade with that same option. So if the market keeps going down on the put, you can just make money all weekend long. Of course, it's not going to move on the week because the market's closed, but on Monday, if the market continues to fall, you make more money even on Monday. But there's no reason you could trade with a 3-day option and then just close it out before the market closes. Right, for today. So you don't have to hang on to it if you don't want to. You can, you don't need to. You just liquidate it. All right. So now, see that? Now the put option that we were making all that money on, the market's starting to come back against us. So now that put option's only up $37. The call that we sold is still at 35 because that's about all it can make. It can only make 37, and it's already made 35. So you've made 93% of your income on that one. So you might as well liquidate that one, take it off, because you got all the money you can make. There's nothing to gain, and there's everything to lose on that one. All right. When you get to that point with an option, you got nothing to gain and everything to lose. Get rid of it. Take it. Take your profits, because I mean you're at 93% profit, and the only thing you can do is lose money at this point. Can't make any more. 37.50 is the max it can make, and you're at 35. Take it off. Take your profits. All right. Now this one here, on the other hand, we were down $100, right? But now we're only down 50 because the market's coming back in our favor, going back up into the triangle. Oh, now it's coming back down. Now it's below the red line again. Ooh, baby. So they gave us 42. We're down 85. So we're losing 40. So we have to give them 75 back. So we're down 32. Oh, that's coming back in our favor. Now we're only down $20. Oh, now we're making money again. Woohoo, baby. All right, we've already made full profit here. We should take that one off. We're not going to, because it's just an example. We're going to watch it. This one, we're trying to look to see if it's going to come back up into the triangle. It's got to hit that yellow line inside that box. These two, now we've got our contract here too. So our contract is long, right, from the center point. So it's coming back. So we're now only down 300. But you can see that's the biggest risk, right? The contract is the biggest risk. The buy call is down 170. Now the buy call, the max amount of money it can lose is the premium we paid for it, which was $177. So that's all you can lose. You can't lose any more on the buy call than what you paid for. $177, that's the max loss. You can't lose any more than that. But yet the put can make way more than $177. So that's why you do straddles and strangles. You do a little straddle like this one, and what happens is that you have a put and a call. So if the market really moves a long ways, you put a put and call right at the same price, you don't know whether the market's going to go up and down. So you don't have to decide. It's called a neutral option strategy. Well, if the market takes off and goes up, well, the call option is going to make unlimited profit potential. The put option could only lose the premium you paid for it. So if it can only lose the premium you paid for it, which in this case was $177, then that's all you can lose. So the other option can make unlimited, so it can pay for the cost of this one, plus pay for the cost of the one of its own, and it can make money over and above the cost of the premiums. So that's kind of the name of the game of that one. But the market has to really kind of explosively move, because if it just stays dead sideways, well, you lose premium on both of them. And then the ones that you sold out here make more money. So it's a carnival game. If you set it up like this and you learn the rules and you figure it all out, it's just a carnival game. It's like, oh, do I think the snaky thing's going to go up, or do I think the snaky thing's going to go down? Well, I think the snaky thing's going to go sideways. It's not going to go up or down. Or in the process of going up and down, it might go up and down, but it's going to kind of stay in the center of going a little snaky thing. All right, the little snaky thing's going to do this. I can put this order on. And a little snaky thing's going to do this. I can put this order on. I could draw this line. It's just kind of like drawing a line in the sand. Oh, I'm going to draw the line in the sand. If the snaky thing stays above it, I make money. If the snaky thing goes below it, I lose money. So it really becomes, how good are you at picking the direction of the snaky thing? Well, I'm not good at picking snaky thing directions. Well, then don't do it. Use neutral option strategies. Buy a call and buy a put, or sell a call and sell a put. You can do either one, right? But if you buy a call and you buy a put, both the exact same price at the money in the morning, and the market just takes off and runs and goes one way and makes a whole bunch of money on one, well, the other one could only lose the premium you paid for it. So you make money anyway. But if it goes sideways, you lose the premium on both of them. But you can only lose the premium you paid for it. So if you pay $177 for one and $177 for the other, the max amount of money you can lose, $300, right? $350. I don't want to lose $350. Yeah, but you have unlimited profit potential. It's the snaky game. That's the game. The snake going to take off and go or not? Okay, it's coming back in now. It's back in the box. So now both of these are going to make money. This one's still sitting at $35 in profit. We have to give $250 back. This one here, now it's making $35. It was down $100, right? So they gave us $42.50. We have to give them $5 back. So we get to keep $37.50 because it's just coming back into the middle. So on the two solds, the sell call, the sell put, sell call, sell put, we've got 93% return on this one on the call, and the sell put, we're at 88% return. So we should really just liquidate both of them and take our money. We've got 88% return on one and 93% return on the other. We're maxed out. There's not much more we can do on that one. Market's going to close in 1 minute, and then look at the market sitting right dead center where we were. Both of our put options, $40, $35, $37.50, $42. That's max profit right there. $35, $40 on our two sold puts. We can't do any better than that. We just liquidate both those and take our profits. Let's go ahead and liquidate that option. See if they'll just market that one. And then we'll liquidate this one. And you know what? On the come on, let me out of there. There we go. So on that put option, when it was up like $100, we should have taken it, right? Should have taken it. I thought it was going to go down more, Lan. Sure you did. Of course you did. All right. So notice here at the close of the bell, the market came right back dead center to where it was. We lost $100 here on the two options that we bought. We bought the call, we lost $172. The put option that we bought, we lost $50. On the contract that we bought, we're right dead center zero. We didn't make or lose anything because the market's right dead center. So the put and the call lost money that we bought. The puts and the calls that we sold, we closed out. We ended up with 35 and 17. We ended up with $52. There you go. That's why I like to day trade by selling calls and puts instead of buying them. You can make more money buying and selling calls because you have unlimited profit potential. And if the market really takes off and goes, you make a lot of money. But if the market's dead like it is today, it did have a little run here. So there was the opportunity for us to take some money off on that put. But when it come back, we ended up losing a bunch of money on the call anyway. So even if we'd have made $100 on the put, we'd have to buy the call, lost all the premium. So we paid $177 for the premium. It's gone. We lost $172 on it. Contracts at zero. It came right back dead center where we got in, so it didn't make anything. All right, there you go. I think that's a great example. Now, what I'd like you guys to do is all next week, I want you to do the same thing. Get your software, go in there, put your calls, put your puts, and we'll start talking about different strategies to way to protect yourself so you don't lose so much. but it also costs you. You have to pay for the premium of the ones that you put in as insurance, right? And this is how YieldMax and Granite Shares, those companies we like to invest in, right? This is how they make their money. They sit here and they do this. And now they don't buy calls and puts. Now, YieldMax does, but Granite Shares, they sell just like this. Granite Shares, this is what they do. This is how they make that premium to give you those dividends that they're sending you. They sell options. They sell puts, just like we did today. They do this one here, sold a put, 1750. That's the one right there. That's a Granite Shares strategy. That's pretty much what they do. All right. Now they're a little bit more sophisticated. They do laddering both in depth and in time. And then they also have some protective stops down there underneath. So they do protect them to the downside in case the market does flush out like a toilet. But that's pretty much how Granite Shares makes their money. Now, on this one here where we sold the call right there, the $35, that's how YieldMax does it. So YieldMax sells calls. Granite Shares, they sell puts. Now, YieldMax also buys calls and puts, right? They do that too. They buy calls and sell puts. But their strategy is a little bit more sophisticated because they do synthetic longs. But the Granite Shares, they just basically do cash secured puts. That's what they do. And the cash that they're using to secure their puts is your money. So you invest into something like TSYY, they're going to go in and they're going to sell some put options on your behalf. And then they're going to use your money to cash secure that put option. Cash secured put. That's what they do. They sell cash secured puts. It's exactly what they do. Now you know. All right, guys. If you have any questions, let me know. And I wanted to, just before we take off and head for the curtain, let's go in and I wanted to show you, for those of you who haven't seen, this is the December issue of Pit News Magazine. You know, I'm always hyping about Pit News Magazine. I want everybody to buy Pit News Magazine.
Hey, Land Turner here. I got a hot stock market tip for you. Subscribe to Pit News Magazine. You can thank me later.
All right, thank me later. But this is Pit News Magazine's December issue. I just wanted to show it to you for those of you who haven't seen it. You're like, Land keeps talking about getting Pit News Magazine. Why do I want it? It's really cool. All right, so I'm going to show it to you. Here's what it is. This is the December issue. Got a pretty cover. Look at that. Everybody loves pretty covers. And of course, this is the letter from the editor. I'm going to talk to you a little bit about what's in the magazine. This is the contents. And then of course, we got a few ads in here to help us along the way. And then this is a nice little poem by Gideon P. Thornfield. I'll play that for you. I don't know if you can hear it. I don't think you can hear it. That the sound's not turned on. But it's everything's recorded. Even the little this actually it's a little song. So you can play that. You can hear the little poem. It's got, we got to do the traditional crossword puzzle, and it's a fun crossword puzzle because it's got not just little hints. These are little riddles that you have to figure out. So you figure out the riddle, and then that's the word. So it's fun. It took me a long time to do this, so appreciate it. It took me a long while. Okay, then Grant Thorne's book is for sale, $7 in here. Portfolio Matrix tells you a little bit about Portfolio Matrix. And then, of course, this is my article, When Robots Take the Jobs, The Trader's Path to UBI, Universal Basic Income. That's why we trade, right? We trade in the financial markets so that when the robots take our jobs, well, we've still got money coming in. That's the whole idea. And so we talk about what that's going to be like. And, we kind of go down different rabbit holes and talk about what it might be like when the robots start taking our money and what we're going to do. Another ad for me, in case you want to talk to me, I can help you, right? That's all that's saying. And then YieldMax weekly payout. This is by Jordan Black. He's got a little article in there talking about the weekly payout pivots, Granite Shares, or not Granite Shares, YieldMax changed to weekly charts, and he talks about that, the pros and cons of that, shows you a couple markets that are not doing the YieldMax thing where they're going every month. These are still YieldMax, but they're called the Target 12. And so he highlights the 3 Target 12 stocks that I think we got 3 more or 2 more coming, a couple more. I think they want 5. And then this is an article from Doc Brown on understanding what ROC is, ROCC versus ROC, and how that all works. And of course, it's recorded, so you can listen to it. And then you have all the written stuff here, so you can reference back when you need to reference back to it. It's got a lot of cool little pictures. I mean, we do, fancy stuff in here. And then, wait, did I just get paid with my own money? Claire Christensen comes in and she goes, I don't understand a damn thing that Doc Brown just said. Lan, can you help me simplify that? So then we have a conversation and we talk about how we simplify it, break it down a little bit so it's not quite so Doc Brownish. And then we have a SWOT report on Chevron because Chevron's on the move. And so we wanted to talk about that. So we got a SWOT report, whether we should be investing in Chevron or not. Of course, we tell you where to go get the playbook of strategies for stock market. And then we have the seasonal stuff. The seasonal stuff is really cool. So we have the end of year insights for the December playbook. And we talk all about, because December's are really kind of a crazy month. And so you have to kind of know how to handle your portfolio in December. So this has you a bunch of strategies that you might want to consider for the month of December. And then we're going to come down a little bit farther and we have trade recommendations. So these are seasonal trade recommendations. So for example, I'll show you this one here. This is BAC, Bank of America. And Bank of America over the past 17 years, 80% of the time, over the trading days between December 24th and January 7th, that's 10 trading days, no more than 25 trading days. The score, it won 83% of the time over the last, how many years? This is over the last 15 years. Oh, that's calendar days, 15 days. Where's the score? Oh, 17, over the last 17 years, 80% of the time, it was profitable. How many times? Where is it? I thought it would tell us a little bit better. Let's see. Bank of Utah begins December 24th, 25th, and 17th. 17 years, 80% of the time over those trading days, it was profitable. So the score is 415, wins 82.35% of the time. There's what the number I was looking for. So over the past 17 years, 82% of the time between December 24th and January 7th, this market's made money. So you can see them all in there. This is the 2 months that it broke. And that one just had a little loser. Then we have this one here, CTSH, Bullish Cognizant Technology Solution. So the winning 82% of the time over the last 17 years, 80% of the times, 82% of the time, it averaged almost a 5% profit. I had a couple of months that are red, but everything else over the last 17 years. That's pretty cool. So that's what we've got. We got a couple of trade recommendations in here. Then we have Claire's Pit News on Air. So this is her podcast, and there's one of these in every single one of the magazines. And then we got this funny thing here. This is a cartoon. This is really Santa Claus coming into America, right? Bring presents, and then they stop him at the border. Where's your green card? And then he's got a little poem down here. It says, ho, ho, hold it. The agent said, that beard looks fake and your nose is red. Santa flew in from the polar zone, but left his green card next to the phone. So that's our funny. We get a funny papers, and then there's the answers. I won't show you the answers. Don't want you to see the answers to the puzzle. And then this is that's the end. All right. So that's just a fun little magazine for you. And I would recommend that if you haven't signed up for Pit News Magazine, then you do that. And here's how you do that.
Ready to level up your news game? Welcome to Pit News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pitnews.com. That's pitnews.com. Pit News Magazine. News your way.
All right, guys, that's what I got for you today. We're going to meet tonight at the university, second floor, room 204, Udvar Hazy building at the university. So if you can make it, we'll see you there. If not, we will see you here sometime next week. Watch subscribe to the channel, get the little bell so you get a notification, and we can come back and we'll do a little bit more of this stuff. All right, we'll have fun. If you have any questions, please let me know, and we'll catch you next week.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pit News Magazine.
Oh yeah, definitely subscribe to Pit News Magazine. You'll thank us later.